Hey everyone, Kirk here with Tactical Options Trading. Today we're going to be talking about credit spreads. Welcome to the video, and if this is your very first time here and you're interested in learning more about options, click that subscribe button and the bell icon so that you don't miss out on any future videos. So today we're going to be talking about credit spreads. And what is a credit spread and why do we use them? So credit spreads are one of my most favorite strategies. Let's get into it and we'll talk about why. So I got a question for you. When you get ready to trade stock, how easy is it to pick the direction of a stock? Let's just take, for example, Apple. Let's just look at a stock chart of Apple here. We're looking at Apple. I mean, do we really know which way the stock's going to go? I mean, we can make an assumption of which way this stock's going to go, but we don't know for sure which way this stock's going to go. So a stock can do one of five things. It can go up a lot, it can go up a little, it can chop sideways, it can go down a little, or it can go down a lot. Sure, there are many things that we can do to get an idea where that stock's going to trade in the future, but the bottom line is we don't know for a 100% certainty of where that stock will be going in the future. We can look at indicators, the company fundamentals, we may have received some hot tip, etc., but the fact remains that we don't know. And how many of us have tried in the past to make an assumption of market direction and were reminded that we don't have a crystal ball? So, why do I like credit spreads so much? Well, the fact is that you don't completely have to be right on picking the stock direction. The stock can actually go against our position and we still make money. So what is a credit spread? A credit spread is an option strategy where a higher premium option is sold or written, same thing, and a lower premium option is bought on that same underlying security. This provides a credit to the account of the person making the two trades. Let's remember that options are a depreciating asset, and they lose value over the life of the term of the contract. And we can measure that value by a Greek term called theta. So what is theta? Theta is used in options pricing and is the measure of the risk that time poses to option buyers, since options are only exercisable for a certain period of time. Options give the buyer the right to buy or sell an underlying asset at the strike price before that option expires. So if you have two options that are similar, but one has a longer time before it expires, the longer term option will have more value since there is a greater chance, given more time, that the option could move beyond that strike price. Theta is the enemy of all option buyers. However, theta is an option seller's best friend. So, back to our credit spread. When we sell a spread, we receive a credit for selling that spread. That credit that we receive goes directly into our account. The goal of selling a spread is to buy it back at a future date for less than we sold it for, creating a profit for us. When we sell that credit spread, theta is constantly working for us. The value of that option is losing value each day. The great thing about theta working for us means that the stock could literally trade sideways with little to no movement, but every day it is losing value. Well, that's good for us because losing value is a good thing for option sellers, as we want to buy it back at a lower price. We want the option that we sold to expire worthless. We generally will sell the options out of the money. Here at Tactical Options Trading, we aim to sell those options around the 30 to 25 delta range. By selling these options at a 30 to 25 delta, we have a 70% to 75% chance that these options will expire worthless. What do I mean by that? Let's go ahead and take a look at the Dow Industrial Average ETF, the DIA. We're going to go ahead and open up the options chain of the 21st of September 2018 series. Now you can see on the options chain we have the call side here and the put side here. Let's say for example today we wanted to sell a put credit spread at that 30 delta. So what we would do is come down here, would find that delta column, come down here to that 30 delta, and that looks like the 250 strike. So we'd be selling that 250 strike. We'll go ahead and click that and open that up. So we'd be selling that position, and then we'd come up here to the 249 and we'd be buying that position. So you can see that that 250 249 put credit spread is giving us a credit of 20 cents, or on one contract would be $20. Now if I go ahead and hit the confirm send, you can see that we'll receive a max profit of $20 on this trade, and if everything went against us we'd have a max loss of $80. And here's why I love credit spreads so much, is that we don't have to completely be right on picking stock direction. Let me show you what I'm talking about here. So if we come into the chart, you can see I've already put a line here at that $250 strike, so that we know that anything that trades above that $250 mark by expiration, we're going to receive a $20 credit. So our expiration date is September 21st. So here's our expiration date. Now this stock could go down, it could go up, it could go really far up, it could come down, up a little bit, down, and up, and then trade sideways. As long as it's above the 250 strike by expiration, we're going to capture all that $20. That's what I love about it. You know, even if this stock did come completely down below our 250 and then turned around and came up and then down and up and sideways, as long as it's above 250 by expiration, we're going to capture that complete credit. In this case it'd be $20. So let's take a look at a profit loss diagram of a put credit spread. So in this example we would be selling the $45 strike, which means that we would want the stock to stay above the 45, and to protect ourselves on the downside we bought the 40 put. So if the stock were to trade down, that we'd be protected on that downside by buying that put, which would actually gain value as that stock went down. But when we sold this credit spread, we want this stock to stay above that 45 strike. By doing so, we would capture all that premium that we sold in the beginning. So in this case, if the stock were above $45 at expiration, our max profit would be $200. Now the beauty of a credit spread is that if this stock completely went against us, we already know what our max loss would be. So in this case, our max loss on this trade would have been $300. Our break-even point on this trade would be that $43 strike, and that's where we sold that put credit spread. So our max profit in this case would be above 45, and our max loss would be below the 40, and anything in between is based, you can see a sliding scale here based on this zero line. So let's take a look at a profit loss diagram of a call credit spread. Now on a call credit spread, it's exactly opposite of a put credit spread. So in this case, we would sell that $35 strike, and we'd want that stock to stay below the 35 strike. Now on the upside, we'd want to buy that 40 strike as protection, so that if the stock did pass our 35 strike and continued to rally up past that 40, then that $40 call would start to gain value. In this case, our break-even point would be 37. So when we sold our call credit spread, we collected all this premium right here, and we would like that stock to be at or above, or I'm sorry, at or below $35 at the time of expiration. So in this case, our max profit would be $200 on this one, and if everything were to go against us, our max loss would be $300 on this one. Here at Tactical Options Trading, we like to sell these credit spreads far out of the money and let the market trade as it does and let those options expire worthless and keep that premium that we collected when we sold the options. So let's take a look at it here as an example on a chart. This is just a random chart, no stock ticker or anything, but let's say I wanted to be bullish on this chart and I thought that the stock might go up, and I wanted to sell a put credit spread. So we would be selling that put credit spread at about a 30 delta, which would be somewhere below the market. So let's say in this example that that put that we wanted to sell at the 30 delta was somewhere down here around that $97. So we'd go ahead and sell that put, and then we'd come in and we'd buy the $96 protection. So that stock could do whatever it wanted to, and it could sit here and trade all over just as long as it didn't come down and penetrate that 97. And even if it did come down and penetrate that 97, as long as it came back up above that 97 before expiration, we would capture all that premium. So let's say that we had a bearish bias on the market and we wanted to go ahead and sell a 30 delta call in hopes that the stock would trade down. So let's look at this chart here, and we'd think that maybe that 30 delta would come in around that $103 strike. So we'd go ahead and sell that 103, and then for protection we'd come up above that 103 and we'd go ahead and buy that 104 strike as protection. So this stock could trade anywhere, up, down, sideways, down, up. As long as it was below that 103 by expiration, we'd continue to capture all of that premium that we sold when we sold this option. So the normal question most people ask is, what happens if the stock trades beyond our short strikes? The answer is that we would lose what we initially put up for margin, which is the difference between the credit that we received and the width of the two strikes. For example, if we sold a spread with a $1 wide strike price and we received a 30-cent credit for selling that spread, then our margin would be 70 cents. So the dollar is the width of the spread minus the 30 cents that we received in the credit would be a 70-cent margin that we would have to worry about, or that we would have potentially lose if this trade were to completely go against us. And that 70 cents would be our max loss on the trade. I hope you found this video helpful. Please leave some comments if you found it helpful. Give me a like if you like these type of videos, and remember to subscribe to us so that you don't miss out on anything.